Welcome to the Deep Dive. Today we're taking a closer look at Palantir, ticker PLTR, a stock that's definitely no stranger to some big moves.
That's for sure.
And if you've been watching the market today, this is August 19, 2025, you might have noticed Palantir is having a particularly rough session.
Yeah, quite a drop.
Shares are down significantly, 6.9% as of around 11 a.m. Eastern Time. And this really stands out when you see the broader markets like the S&P 500 and the NASDAQ seeing much smaller declines.
It's definitely a headline grabber. I mean, when a company known for, really rapid growth like Palantir takes a hit like this, people notice.
Right.
So our mission here in this deep dive is to unpack not just the immediate reason for today's drop, but, put it in context. We need to look at Palantir's business, its recent performance, and maybe the unique challenges of investing in these really high valuation tech names.
Okay.
We'll be pulling from, recent earnings reports, analyst takes, market commentary, just trying to give you the full picture.
All right, sounds good. Palantir is definitely making waves today.
Yeah.
So let's jump right in. What's the immediate trigger? What's the specific news driving the shares down right now?
Okay, so the big news today, the most immediate factor, is a pretty critical short report. It came out from Citron Research.
Ah, Citron. They're known for making waves themselves.
They are. They're one of the market's most prominent short sellers. Their core argument is pretty bold. They're essentially calling Palantir's current valuation irrational.
Irrational. Wow, that's strong language in finance. What's the basis for that? I mean, how are they backing up such a strong claim?
It really all boils down to a comparison they're making, a direct comparison with OpenAI, the company behind ChatGPT.
Okay, OpenAI, huge name right now.
Exactly. Citron pointed to OpenAI's latest valuation. It was just confirmed last Friday, actually. A huge $500 billion valuation from a new $6 billion funding round.
$500 billion, okay.
And Citron calculates that this valuation implies a price-to-sales ratio, the PS ratio, of roughly 17 times for OpenAI.
Right, PS, how much you pay per dollar of sales. Higher means higher expectations.
Precisely. So 17 times for OpenAI.
And how does that relate back to Palantir then?
Well, this is Citron's core point. Their report suggests that if you took that same 17x multiple, OpenAI's multiple, and applied it to Palantir, Palantir stock would hypothetically trade at just $40 per share.
$40, wow. Okay, compared to its current price around $162, that's a massive drop.
It's a steep, steep difference. And the report really hammered this point home, highlighting that Palantir stock currently trades at roughly 7.5 times the implied sales multiple of OpenAI.
7.5 times higher PS than OpenAI, using OpenAI's number as the benchmark.
Exactly. Think about that. They're saying Palantir commands a PS multiple nearly 7.5 times higher than this AI darling, OpenAI, even using OpenAI's own PS ratio, which, as we'll get to, is already considered pretty high.
Okay, wow, that's a stark comparison. But is OpenAI's 17 XPS even like a normal benchmark? Should we even be comparing them directly like that? They seem like very different businesses.
That's a really important question, and the answer is, well, no, not really. It's not a typical benchmark.
Okay.
And interestingly, Citron itself actually stated in the report that OpenAI's 17x PS multiple is extreme for any scaled SaaS stock in the world.
So even Citron admits the benchmark they're using is extreme.
Right, which implies that even if Palantir did drop to that hypothetical $40, it would still be considered incredibly expensive by that specific OpenAI metric.
I see.
It really underscores Citron's broader point, which isn't necessarily about hitting exactly $40, but about just how stretched Palantir's current valuation seems compared to, well, almost anything else, even other high-flying tech names.
It's quite a contrast they're painting. But okay, Citron's making this bold comparison. What's the counter-argument? Or are there nuances here we need to think about? Because, like you said, just applying one metric isn't always the full story.
Exactly, and that's critical. There's a huge caveat here, and it's something acknowledged even by people who might broadly agree with Citron's concerns about valuation.
Which is?
Palantir is profitable. Very profitable, actually. It generates significant free cash flow.
Well, that's the cash left over after running the business and everything.
Yeah.
A sign of health.
A very strong sign of health. In stark contrast, OpenAI, despite its massive valuation, is currently, quote, burning cash at an incredible pace. They're pouring everything into R&D, scaling up.
That's a fundamental difference in their financial profiles right now.
A massive difference. But for Citron, it seems, the sheer disparity between the two valuations is the main point. The argument isn't so much Palantir should be $40, but more like, Look how much future success is already priced into Palantir at $160.
Okay.
They argue Palantir needs to keep up this breakneck pace of growth for many, many years just to justify where it is now, a level of, perfection that many find not reasonable.
So it's less about the target price itself and more about the implied risk if anything goes slightly wrong.
Precisely. It's about the lack of margin for error baked into that high price.
Okay, so the short report is the immediate catalyst, the big news driving things today. But it feels, I don't know, a bit jarring compared to what we were hearing about Palantir just, 2 weeks ago?
Yeah, exactly.
I remember a lot of buzz around some really strong earnings. Wasn't Palantir doing, really well very recently?
You are absolutely spot on. Just a couple of weeks back, August 4th, Palantir delivered what many people were calling its strongest quarter ever. That was their Q2 2025 earnings.
Strongest quarter ever.
And the market loved it initially. The stock jumped around 8% pretty quickly, pushing up towards that $160, $161 level. So yeah, this recent performance makes today's drop feel even more sudden for investors who just saw that positive reaction.
What specifically made those Q2 results so blockbuster? Can you give us some highlights, the numbers that got people excited before this Citron report landed?
Yeah, the numbers were genuinely impressive. They reported a record Q2 revenue over $1 billion. That was up 48% year over year, well ahead of what analysts expected.
48% growth, that's huge.
It really is. And digging in, U.S. government revenue, their traditional stronghold, climbed 53% to $426 million. Still very strong.
Okay.
But maybe even more eye-catching was the U.S. commercial revenue. It nearly doubled, up 93% to $36 million. Management put that down to explosive AI adoption in the private sector.
Wow, okay, nearly doubling commercial. That shows they're expanding beyond just government contracts.
Exactly. And it wasn't just revenue. Profitability looked great, too. Adjusted earnings were 16 cents per share. Net income soared 144%. And their GAAP operating margin hit 27%.
GAAP margin, right? That's the standard accounting profit margin. 27% is pretty healthy.
They're very healthy. And crucially, linking back to our earlier point, they converted over 50% of that revenue into free cash flow.
50% FCF conversion. That's impressive.
Extremely impressive. And on top of all that, management actually raised their guidance for Q3 and the full year 2025, which is usually a strong positive signal.
Okay, so the company delivered. Solid numbers, clear growth, especially in AI, strong profits, raised guidance.
Yeah.
Here's the disconnect I keep thinking about. How did the broader analyst community react to that news? Because that often tells a deeper story than the initial price pop.
And this is exactly where that underlying tension, the caution, really comes through. Despite those fantastic results, despite the raised guidance, many analysts stayed, cautiously neutral.
Neutral, even after a strongest quarter ever?
Yeah. The average price target across analysts barely edged, lingering around $17, which, remember, was about 30% below where Palantir was trading after that earnings pop.
30% below, wow.
And get this. Out of 12 analysts covering the stock at that time, only 2 actually had a buy rating. The rest were hold or even underperformed.
So the majority weren't recommending buying, even after those results.
Correct. Big firms, Goldman Sachs, UBS, Citigroup, they all acknowledged the solid fundamental execution. They saw the numbers, but they kept flagging high valuation as the key risk.
It's just a fascinating disconnect, isn't it? Strong performance, clear momentum in AI, but this persistent anchor of the high valuation weighing on analyst sentiment.
Exactly. It really highlights this core issue for Palantir.
Yeah.
It's widely seen as being priced for perfection.
Priced for perfection. We hear that term a lot with growth stocks.
Yeah.
What does it mean in Palantir's case?
It means the market isn't just betting on Palantir doing well. It's betting on Palantir doing, essentially, flawlessly, quarter after quarter, year after year.
Room for error.
Basically none. When you look at its valuation metrics, like an enterprise value to sales multiple around 100 times based on 2025 forecasts.
100 times sales.
Yeah, or forward price to earnings ratios maybe in the 200 to 300 range. These are just extremely rich numbers.
Compared to what's typical.
Well, a healthy, fast-growing tech company might trade at, say, 5 to 10 times sales, maybe 30 to 50 times forward earnings. Palantir is multiples above that.
Okay, that puts it in perspective.
So those extraordinary multiples signal that the market is expecting not just growth, but hypergrowth, massive profitability improvements consistently far into the future. Investors are absolutely banking on consistent execution and acceleration quarter after quarter.
And any sign that that perfection might crack.
Like a critical short report today or maybe a slightly softer outlook next quarter, that can send the shares tumbling because there's just no cushion, no margin for error priced in at these levels.
This definitely isn't the first time we've seen Palantir make big moves or face this kind of scrutiny, is it? I mean, beyond today's report and the recent earnings reaction, what other factors contribute to its, let's call it, unique journey and its volatility?
You're absolutely right. Palantir's been volatile basically since day one as a public company. One huge recurring theme is that heavy reliance on government contracts.
Right, you mentioned the strong government revenue growth earlier.
Yeah, but it cuts both ways. As of February this year, over 40% of its quarterly revenue still came from government deals. And we saw how sensitive the stock is back in February 2025. Remember those reports that the Trump administration was maybe pushing for an 8% cut in the defense budget?
Vaguely, yeah.
Well, Palantir stock dropped 10% pretty much instantly on that news. Just the suggestion of budget cuts raised immediate concerns about its core business health. It shows how tied its fate can feel to government spending cycles and political wins.
But surely these big government deals can also be a massive positive. I mean, they're often large, stable, long-term contracts once you win them.
Oh, absolutely. It's definitely a double-edged sword. Winning a big one provides huge revenue visibility credibility. Like in May 2025, Palantir landed a $178 million contract with the U.S. Army for AI capabilities.
Okay, that sounds like purely good news.
You'd think so. But even then, the stock actually dipped 3% that day. Again, attributed to just general market volatility and maybe some underlying regulatory uncertainty. It shows how closely the market watches everything with Palantir.
Wow. Even good news gets scrutinized intensely.
Exactly. But on the flip side, the potential upside is huge. Management has talked about a potential like $10 billion enterprise agreement with the U.S. Army. If that ever happened, consolidating lots of smaller contracts. Well, that would be massive for long-term revenue visibility, a
Yeah.
potential game changer.
That's quite a range of possibilities just within the government sector. What else contributes to its wild ride?
Well, another area the market watches is international growth, especially on the commercial side. While international government sales grew nicely in Q2, up 37%, international commercial sales actually declined.
Declined. Okay, that's not ideal.
No. And that imbalance could limit its future growth runway if it can't get more traction with businesses overseas. It points to a potential weakness or challenge.
Makes sense.
And then there's just the historical pattern of volatility around earnings. Since going public, the stock has moved, on average, plus or minus 16% the day after earnings.
16% swing on average.
Yeah. And sometimes it's down, even after seemingly okay numbers. Often driven more by the tone from management or the sentiment around future guidance, rather than just the raw reported numbers.
So very sensitive to perception and outlook.
Extremely. And you also have things like, back in February 2025, news came out that CEO Alex Karp had a plan to sell a significant chunk of shares, nearly 10 million, by September. Now, there can be many reasons for insider selling, but it's something that can influence market sentiment, add a bit of uncertainty.
Okay, so if we pull back and connect all these threads, the short report, the valuation concerns, the government reliance, the international picture, the earnings volatility, insider selling, it all feeds into what we generally call market risk, doesn't it? Just the fact that the stock market itself is just inherently volatile. Daily ups and downs happen, influenced by everything from specific company news to broad economic shifts or even geopolitical events. It's just part of the landscape for investors.
It really is. Market volatility is unavoidable. It's the risk that prices will fluctuate just due to market forces, sentiment shifts, macro news. And for a stock like Palantir, which carries such a premium valuation, such high expectations baked in, it's particularly sensitive. These broader market shifts, combined with company-specific news like today's short report, they can lead to these really dramatic, stomach-churning moves.
It's a constant dance.
It is. Between the company's actual performance and how the market perceives that performance and its future prospects, things like diversifying your portfolio, having a long-term view, these are common strategies investors use to try and weather this kind of volatility. It's a reminder that investing always involves risk, and understanding your own tolerance for that risk is crucial.
So after unpacking all of this, what's the takeaway for you, the listener? We have this company, Palantir, with undeniably strong tech, explosive growth in AI, which is huge right now, significant government ties.
Right, real fundamental strengths.
But also these persistent, nagging concerns about its sky-high valuation, its sensitivity to market mood swings, economic shifts. How does someone even begin to reconcile these these contrasting forces.
Yeah, that's the multi-billion-dollar question, isn't it? It really highlights this ongoing tension for Palantir. It is evolving. It's moving beyond just being a narrative stock, valued on its story, towards becoming a real revenue engine built on actual performance and profits.
Okay.
But those premium multiples, that 100x sales we talked about, they come with incredibly high expectations. Investors aren't just looking for growth, they're demanding consistent, flawless execution. They want efficient reinvestment, no margin pressure, no guidance cuts.
Zero tolerance for error.
Pretty much. Any hint of weakness, any sign of softness, whether it's a short report like today's or maybe just slightly less optimistic guidance next quarter, it can trigger a really meaningful pullback because the market is constantly reevaluating if those perfect expectations are still justified.
It also feels like there's a fascinating dynamic here between different types of investors. Palantir seems to really polarize people, doesn't it?
Oh, absolutely. There's a very palpable divide. On one side, you have retail investors. Many remain incredibly enthusiastic. You see it online, on social media, in the trading volumes, on retail platforms.
What are they focused on?
Often the disruptive potential of the AI tech, the long-term vision, the idea that Palantir could become this foundational software layer for governments and large enterprises. They're betting on the big picture.
Okay, the retail bulls. And on the other side?
You have the institutional firms, the big funds. And while they were clearly impressed by the Q2 numbers, as we discussed, many continue to urge caution, primarily on valuation. They look at the multiples and get nervous.
So retail enthusiasm versus institutional caution.
Exactly. And that divide definitely fuels some of the volatility, those sharp swings. But, it also provides a kind of unique potential floor of support.
How so?
Well, if Palantir keeps executing flawlessly, if it keeps delivering that growth and profitability, eventually those cautious institutional funds might feel like they have to increase their positions. They risk underperforming if they miss out on a stock that just keeps defying the valuation concerns. That could potentially lead to another surge down the line. It's this constant tug of war.
Fascinating dynamic.
So wrapping it all up, Palantir's significant drop today, what kicked it off was largely this prominent short seller, Citron, challenging its valuation with that stark OpenAI comparison.
Sorry, the immediate catalyst.
But that single event is playing out against this really complex backdrop. Truly impressive recent earnings just weeks ago, yet these persistent, deeply ingrained concerns about its price for perfection valuation, its heavy reliance on government contracts, and just its known history of making big, sudden moves.
It really is a classic case study, isn't it? A company with genuinely compelling technology, strong business execution, but it's constantly wrestling with market perceptions, with sentiment, and just the inherent risks that come with being a high-growth, high-valuation darling.
Absolutely.
So for you, the listener, hopefully this deep dive gives you a framework for thinking about this interplay. The fundamentals matter, of course, but so do market sentiment, external shocks, and just the weight of those future expectations.
So as you look at a stock like Palantir or others like it, what truly stands out to you? How do you personally weigh that undeniable technological edge, that impressive growth, against the market's constant, sometimes harsh reassessment of its worth, and those incredibly high expectations that come attached to that premium price tag? It's something every investor has to grapple with.